gold prices don't correlate well with inflation. So why is this belief, still out there? And what types of inflation does gold do a good job of accounting for?
Yeah. It's funny because Roy Jastrom in his book, The Golden Constant, that was his conclusion. He said, gold does really well in protecting you against catastrophic inflation, really high inflation. And we saw that in the 1970s at a time when you didn't have a lot of other inflation hedge investments, So gold and silver were the inflation hedge investments. And when you had inflation of 7%, 10%, and then 14%, gold and silver did very well because investors were moving their assets into them. And that is true. But what gold doesn't do well is it doesn't correlate to that 2%, 3% inflation that's ongoing. That's the basic inflation rate over the last 30 years. And really, if you take out the 70s, over the last 50, 60, 70 years, that's a core inflation. And it's a gnawing thing that slowly but surely eats at your buying power. And gold doesn't correlate well with that. When things get nasty and inflation goes to 7%, investors start buying gold hand over fist, and gold correlates closely with inflation. But when it's at 2%, it doesn't necessarily do it.
So when you say 7%, is that year over year sustained, or what do you mean when you say 7%?
The sustained word is a very important word. No, it's 7% on a spike, which is what we saw, I think, around 1974, 75, it's really spiky. And that sustained thing is a very important thing, because in one of the CPM Group's videos last week, we were talking about gold and inflation. I was saying, well, there are these people out there talking about get used to, we are now in an era of 20% inflation. Well, we're not in an era of 20% inflation. Even if you use headline inflation, we've seen 2 months of 5.3%, and 2 months do not make an era. And if you look at it historically, when we have seen high inflation, it hasn't gotten to 20%. And you can go back to 1800 and it hasn't gotten to 20%. And you can go back to 1700 in the United Kingdom and it hasn't gotten to 20%, except a few times it did. Right. But even when it gets to 10% or 7% or 15% or 20% or higher during the Great Depression or World War II, it lasts for a month or two and then it comes down. And that's what I was saying. If you look at the data for the last year, this year, where people have become concerned about inflation, you saw 2-3% month over month inflation early in the year. And then it got up to about 0.9, and now it's back down to 0.4. Now, if you look at it on a year-over-year basis, it was much higher inflation all year long. 4% core, 5% headline inflation. But you have to understand that you're measuring it against 2020, when we had a global economic lockdown and no one was buying anything. So there was very little demand, and prices fell, and inflation was low. If you look at it 2019 to 2021, you're looking at about 2.5% annualized inflation. So you're really not looking at a spike of inflation, but so many people look at it year over year. So now you're looking at 2020 to 2021, and you're seeing 4 or 5% inflation. A year from now, you're going to be looking at 2021 when we have high prices, and 2022, when things presumably will have normalized some, and you're going to have deflation. Mm-hmm. Yeah, because prices will have come down. You already see that, in used autos, which is one of the two big factors rising in the summertime, petroleum-based energy and used autos. Used autos are rising 40% a month in the summer, and now they're like in August they were off 1.5%. In September they were off 0.7%. So the prices are already deflating.
So as we talk about these storm clouds possibly gathering, further out there, you recently put out an interesting video showing the behavior of the central banks buying gold. So why are the central banks more price sensitive than the retail investors?
Well, I guess yeah, that's a tough question. Maybe it's because they're a committee of smart economists. They tend to like to buy low and sell high. And investors tend to not buy when the price is low, but buy when the price is rising. So, a lot of investors would gladly give up the first 10% or 20% of an upward move and buy into a rising price, which then reinforces the upward move in prices. And they feel smart until it stops rising, and then it falls back. And they don't sell high, and they don't sell into a falling market until the very end. And so then they sell low. And central banks try to avoid that. But, investors have a range of investment horizons from 1 week or 1 day to open-ended. And a lot of investors, like a lot of institutions, will say, what's my projected return over the next 3 to 5 years? If I'm going to make this investment, I am going to probably want to liquidate it within 3 to 5 years. So what's my potential return, my IRR, that I can project over that period of time? Central banks, generally speaking, buy gold as a monetary reserve asset. So they're not looking to sell it. They're saying, we need monetary reserves to support our currency and to protect our currency and our economy in times of global financial unrest. And so therefore, we're going to buy it and we're going to store it. In that way, they're sort of like the silver stackers. The silver stackers say, we're not really investing in silver, we're stacking it up. And what the difference is a matter of semantics. Sure looks like an investment. And I think the IRS would call it an investment too. But central banks are a lot like silver stackers. They're buying gold, and they're not buying it with the expectation that they're going to sell it in 3 to 5 years. So they like to buy low, and they've tended historically to buy low. And then you say, okay, define low, and low changes over time. So, in 2000, 2001, low was below $320 an ounce. By 2007, it was below $500 an ounce. By 2010, it was below $1,000 an ounce. By 2014, it was below $1,200 an ounce. And what we saw in the period March, April, May of this year was a number of central banks, some of whom had not been previous significant buyers of gold, buying gold between, say, 1740 and 1840. So you had you had central banks basically saying, we still want to buy low, but our definition of low has risen, and it's risen significantly, partly because the gold price spiked up to $2,000 in 2020. And so that tells us that on a rewind, it's probably going to go past 2,000 again. So $1,800 actually might look like a good price to buy as a long-term open-ended investment.
I know this might be a difficult question to answer. I know I've gotten it many times, but where do central banks source the gold that they want to buy, Jeff?
Generally speaking, they buy it through the global banking market, so local London. They will buy from each other. That was more the case back in the day when you had European central banks and other central banks that were ready sellers. There aren't a lot of ready sellers right now, but it used to be that you would see a central bank say, I want to sell. And they'd say it to themselves and they'd say it to their friends. And the Bank for International Settlement actually did a lot of work brokering this and saying, okay, well, you want to sell and this central bank wants to buy. So you sell it to us and we'll sell it to them. And that allows you to say, we sold our gold, but we didn't sell it into the market. We sold it to another central bank. But that is something of the past because there are fewer central bank sellers rather. So nowadays, what you tend to see is that the central banks will buy local London or local New York, and usually they typically like to keep it in London or New York, depending on the bank. I mean, one of the trends that we saw 20 years ago was that Islamic central banks started saying, I really am kind of uncomfortable having my metal in Europe or North America, so I'd rather have it other places. So you started seeing it stored in other places.
So what consideration do you think that there for countries that aren't buying gold, that don't hold any gold reserves, like Canada, for example? Why would they not hold any gold? Are they not worried about, protecting their currency, or do they not just think that through properly?
No, they think it through properly, and they are worried about defending their currency. Let me just sort of add to the previous question's answer, which is a lot of central banks, China, Russia, Uzbekistan, Kazakhstan, they tend to buy from locally refined metal, either mine production or scrap. So almost all of the gold that you saw, like for example, Uzbekistan, I think in September or August, added 1.3 million ounces of gold to its reserves, monetary reserves. That was gold that it sourced from domestic Uzbek production. Going on to Canada, for example, Canada is a country that actually says, yes, because we're not part of the European system and because we're not the United States, we do have a lot of currency risk and volatility exposure for our currency. And in that kind of environment, we might need to defend our currency at times. Defending currencies by buying your domestic currency is far less common nowadays than it was prior to, say, 1999 or so. But it used to be that one of the things you wanted to have was monetary reserves so that you could buy your currency if it was under downward pressure and you wanted it to not fall further. Canada says we have those exposures, and the best currency to have in that environment is the US dollars. So what you saw back in the 80s and 90s was a lot of central banks saying, well, we've got 90, 95, 98% of our monetary reserves in gold. And if we have monetary reserves that we will use to buy our currency, when we buy our currency under pressure, we're buying it with US dollars. So if we had our monetary reserves in US dollars, we can go into our currency market and make those defensive purchases of our currency. If we have 90% of our assets in gold, we have to first sell the gold for US dollars. The gold market is a fraction of the size of the US dollar size, and it's a very transparent market for the core people and opaque for the outside market. The outside people really don't have a good vision of what's going on, but the interior core participants in the gold market see it coming. So if you are a banker and you see a central bank selling its gold for US dollars, you know what's going to happen to the US dollar market and to its currency. So you're giving up a lot of the opacity that you want to support your currency. So a lot of central banks in the 80s and 90s sold gold to build up their dollar reserves because that's what they might need to defend their currency. And Canada is in that group. It was interesting because in the 90s, before we went into the euro, the Danish central bank was selling gold. And somebody asked the central bank manager, why are you doing that? He said, well, in case we need to defend our currency. And the Bundesbank got really upset with that answer because that implied that the Danish central bank was less than 100% committed to the stability of the euro. It's like, wait a second, you're going into the euro. You're not going to have to defend your currency after a couple more years. For you to suggest that you might want to build up dollar reserves in case you need to defend your currency is almost to imply that you think the euro might not come off. Yeah, so that's one of the nuances that we saw back in the 90s.